Hello again, I'm Trevor at Heritage Reverse Mortgage. This is your April 2025 interest rate update. It is April Fool's Day, and we're going to talk about what interest rates are doing and where we think they'll be going over the next couple of months. Now, as a quick recap of where we've been, if you've been watching my past couple of videos, you'll see that interest rates peaked for us this year in mid-January. Since that point, January, February, we saw a big drop off on interest rates. We got as much as a 0.5% improvement. Unfortunately, as soon as we got into March, things kind of stalled out, and we haven't seen the decline in interest rates we were hoping would continue throughout the month. However, the past few days are showing promise again. And so even though we're starting April essentially where we left off when we started March, we do have momentum in our favor again. And so hopefully April will be a much better month in seeing interest rates come down. So what's driving this movement? Well, the biggest concern right now in the economy, of course, is tariffs. Tomorrow is April 2nd, and the presidential tariffs that President Trump is proposing are set to come out. Now, a lot of people are worried about this, especially the stock market, because of the impact this would have on business. My personal opinion, I'm gonna give a couple of thoughts regarding what I've been studying and how I think this will affect us. And if you want to go into greater depth, you can read the article. But bottom line is that yes, tariffs would raise prices on the goods that we buy from other countries. However, what has also been happening over the past few months is that the dollar is gaining strength over other currencies, and in a very real way. If, for example, if you're buying a $1 candy bar from Mexico and there's a 20% tariff added, that means your $1 candy bar goes up to $1.20 for you to buy it. That's inflationary. However, if the dollar gains 20% value over the Mexican peso, that same candy bar only costs 80 cents. And then once you add the 20% tariff, it only goes up to 96 cents. And so in a very real way, this is what will help to offset a lot of the inflation that may be associated with these tariffs, is that the dollar is doing great. In relation to a lot of currencies around the world, the dollar is doing very well. And this could really help us. Another issue that comes up with the tariffs for me is just Econ 101, supply and demand. If the cost of the goods we're buying from other countries is going up, it means we're going to buy less of them. It means that those producers are either going to have to produce it for a lower cost, or they're going to have to cut their costs for us to continue buying. And this is just a random example, but I've heard it said that the cost of an iPhone to produce is under like $50, and even that is a high estimate based on some of the figures I've heard. But we're buying iPhones in America for $1,500. And so if we stop buying iPhones, is it likely that Apple will stop producing them? No, they'll just start selling them at a cheaper price, and that is likely what we'll see as a result of these tariffs. Yes, the immediate impact of a tariff will cause the cost of a product to go up, but the lower demand of that product will force the producers to drop their prices to create more demand again. And so long term, I think this is actually going to be very good for Americans. It will lower prices. It will increase producers in America, manufacturing jobs in America, and ultimately I do think that this will go to strengthen the American economy and the American dollar. But again, that's my opinion. Other things that are going to be driving interest rates that we're watching, of course, is the unemployment rate. I've mentioned this before in other videos. The issue is that the Fed is watching the wrong number. The Fed follows the U3 unemployment rate. And the problem with the U3 rate is that it only includes people who have lost their job and are looking for a job over the past 4 to 6 weeks. But of course, if you ever lost your job, you know often it takes longer than 4 to 6 weeks to find a new job. The U6 unemployment rate is a better indicator of what's really happening with the jobs market. The U6 unemployment rate includes people that have lost their job recently. It includes people who have lost their job within the past year and still looking. It includes people who have taken part-time jobs but wish they could have full-time jobs. And when you compare these two, the U3 rate is only roughly 4%, 4.2%, whereas the U6 rate, the real number of people who are underemployed or unemployed, is closer to 8.5%. And so again, depending on who you're talking to, if you talk to the stock market and the Fed, the economy is great. If you talk to the actual consumer, the economy it stinks, and it has stunk for a few years now. And so, bottom line is, as I mentioned before, interest rates are a result of the strength of the economy. And so, if the economy is not as strong as we've been told for a few years, that would lead us to understand that interest rates have to come down. And that is my personal opinion. That over the next year, we will see interest rates coming down. I don't know how much. There are some arguments there that we could get into, but needless to say, we will see a significant drop in interest rates that could benefit many of you by refinancing or resetting your mortgage or buying a new home with a more affordable interest rate. So if you have questions, of course, let us know. We'll continue to get these out to you once a month so you can stay in tune with what's happening and be watching the market to be ready to take advantage of it when it does get better. So thanks again. It's Trevor at Heritage Reverse Mortgage. Call us at 435-359-9000 or visit our website at heritagereversemortgage.com. We'll talk to you soon.